logical difference between buying a stock and buying maybe a, let's say, real estate investment is the use of a lot of debt. Hi guys, and welcome to another video by Metame's YouTube channel. My name is Alan Arundan, and today we're going to be discussing about a concept which is often tested in interviews, wherein students are required to make real estate valuation models. And since most of us have worked on DCF valuation related to, let's say, stocks and basically businesses, so our experiences with real estate valuation is not there, and more so, the main reason for that not happening is because of the nuances of real estate valuation. Otherwise, the conceptual wise real estate valuation is in fact much more simpler than even DCF valuation for stocks. So, without wasting any more time, first I'm going to take you through the basic concepts, which so that you get accustomed to the names and the nuances and the concepts, and then once we are done with that, then we can get into the actual modeling. So there's a template which I will be sharing. There are two sheets to it. One is the solved and one is the unsolved blank one. So the blank one, of course, you can try to do it along with me, and the solved one you can do it once to check whether your calculations are right or not, right? So let's get started with the concepts first, and let's first understand what is real estate valuation and why this is even a concept that we're discussing today. More or less, a lot of companies in India, including big names like PwC, KPMG, tend to offer services to companies which do real estate investments abroad. So there are a lot of companies in Hong Kong, there are a lot of companies in Singapore, there are companies in US who are into real estate business in investing, just like stocks and just like any other asset class, to which we are offering them services of, knowledge based services like valuing the assets, researching, etc., right? So in essence, what we are trying to say is that we want to acquire a property. So I mean, just like any stock, we would acquire a stock in the same way we would acquire a real estate property, maybe run and maintain it depending upon what our intent is, which we will discuss at the second part of the lecture, and eventually sell it to create profits. More or less, that's the concept in any assets, right? Now what differs is the logical difference between buying a stock and buying maybe a, let's say, real estate investment is the use of a lot of debt, right? So in real estate, we must know that, of course, debt is easily available, right? So you tend to purchase the opportunity with high debt and preferably lower interest rate, because that would make more sense, because if the interest rates are too high, then probably the rental increment of rentals across years will not be that great, right? So you acquire it, so maybe around 70 to 80% of debt is what you infuse, buy that property, either improve the property, earn rent to it through years, get your cash flows back, maybe even manage your interest payments using the rent of the property, and then eventually sell it at a higher price at a later. So it's a very simple transactional logic to real estate investments, and it is very not different from how probably any individual person would buy a real estate property, use a lot of debt, and at the end sell it, if the person is doing it from an investment angle, right? And more or less, that is also very similar to what we call it as a leverage buyout model. So just that leverage buyout, we are applying in case of companies, wherein instead of a real estate property, we are taking a public company, maybe a private company, doesn't matter, using a lot of debt. We are taking the company, right, using the proceeds, the cash flows of the business to pay the debt, and eventually sell off the business at the end, right? So that's the basic logic, and hopefully you also understood where the jobs are coming in real estate, right? Real estate valuation. So what kind of property? So when we generally think about it, most of the times we are accustomed to think about properties in terms of just offices and individual tenant based property, right? But there are various kinds of property which are in the ambit of investments. For example, offices, There could be industrial, properties, right, which probably have been shut down, and somebody can come and acquire it and lease it out again. There could be retail shopping centers which could be acquired and it could be improved, or it could be let out and then again sold. It could be storage houses, it could be hotels which are abandoned, or maybe, for example, Hyatt in Mumbai has gone bankrupt. So maybe some interested real estate investor can come and acquire, probably give it to someone else, improve it, earn the rent, and sell it off eventually. So do not get accustomed to the fact that property just means a societal property, or a small shop. There are various kinds of office. Obviously, it depends upon the scale of the investment also. Now, what are the various approaches in real estate investments that is used, right? So one is, of course, the acquisition method, right? Now, what do I mean by acquisition method is what I will try to explain you the three approaches. Now, very plain and simple acquisition method is nothing but what we just discussed, is when we are trying to acquire an existing property, and then basis what the quality of the property is, there are these three methods. So if the property is in a very nice posh area, it's a stable rent scenario, then you would call it as a stabilized method, right? The value add is when probably the property is not in great shape, so maybe you would like to improve the property a little bit and again earn the rent and then sell it off at a later stage, right? Opportunistic is when these are distress sell, like when the probably the business has shut down, or maybe there's a wide recession going on in the area, or maybe the businesses are not working well. So you would try to grab that opportunity, hold it, improve it, rent it out, and eventually sell it. The development method is the other tangent, wherein you could have a merchant developer, or who could also use a long-term hold. Now, what is a merchant developer? So you would acquire the land, you would develop the land, and just like what you exactly see in India, most of the kind of real estate investments that we're talking about, the developers that we're talking about, fall under this section, right? Because they acquire the land, they develop the land, and eventually they will sell it off at an early stage because they want to really earn the cash flows back pretty soon. The long term hold is a little different, that the person would develop in the same way but would not sell it off, probably would lease it for a long time and then probably would sell it. So maybe malls would fall under that category of real estate investments. So these are the approaches to real estate investments. Now let's move into what are the important matrices. Now these are the matrices which tend to confuse us because we've not heard about it in general financial statements. So there's a concept of capitalization rate, which often will come is spoken about in real estate languages. So it's the street language, you can say. So that is nothing but net operating income, which again is nothing but probably EBT in case of a financial statement. And if you divide that by the current market value of a stock or the current market value of a real estate, in our case, then that would give you the cap rate. Now, in essence, what are we saying? It's very similar to dividend yield if you think about it, right? Whatever the dividend the stock is giving you, if you divide by the price of the stock, that gives you dividend yield. In a similar manner, in real estate, if you take the rent in a normal real estate investment, and if you divide by the price, you would call it as rental yield. But just because we are talking about a larger real estate investment, which also deals with maintenance, marketing, finding customers, hence we are talking about not just rent, but we're talking about net operating income, because we would take the rent and you would reduce a lot of other expenses which are needed to run the real estate asset itself, right? So these are the two major, I could say, the matrix which are often used in real estate valuation. The other things now are the variants of this. So once you know the cap rate, what exactly is cap rate? Now these cap rate based on the timeline of the investments are used to identify whether we are selling it at a higher rate or a lower rate. So the acquisition cap rate, so I'm going to start with the acquisition cap rate, because whatever price you give at the time of the purchase of the property, that's called the acquisition cap rate. So if let's say we go and purchase a property, and at that moment whatever the net operating income is there, if you divide that by the value of the property, that would give you the acquisition cap rate, right? The exit cap rate would be a hypothetical rate at which probably I'm thinking that I will sell it off. So maybe the acquisition rate, maybe the net operating income is XYZ value at, let's say, year 10, and divided by the value at which probably I will sell it. So that could give you the exit cap rate, right? The vacancy lost, because a real estate complex or a property is very seldomly 100% occupied, right? So you tend to assume a certain vacancy rate in your calculation, and that is what is called as the vacancy lost, right? So these are, I would say, a very large level, 30,000 level view of the various matrix concepts that you need to know before you get into creating the financial model. So now let's get into the actual model. I did an example here. Now this is a simple example, I would say, not really a very full-fledged model, but I think in terms of your intent of learning the basic concept, or maybe if you're preparing for an interview which is asking such questions on real estate valuation, this might help, right? So we've got some assumptions here. So in the assumption sheet, you can see we've got the asset type. I've just mentioned it as commercial complex, right? Now the difference here is, now you need to get used to the various units which we are using. So in this case, if we acquire this property, then the total square feet that we are actually acquiring is about 2,95,556 square feet, right? And the total units which are there is about 8 units. That means one unit or one office is about 75,000 square feet. It really doesn't matter that way, but still we should look at it also. We should know how to calculate per unit cost also, right? Now purchase price per square feet is about $411. Okay, that's the rate which is available. The vacancy rate, which means that out of 100, let's say 8 units at a time, we are assuming that about 10% or one unit might not be functional or might not be rented out. The exit cap rate we are assuming as 5%. The rent assumption is $40 per square feet per year. Okay, so this is not per month. And then there are other assumptions, operating assumptions, which we have taken for maintenance of this entire complex or property, commercial property, whatever you want to call it, right? Now, how are we going to fund it? So we're going to fund it 65% debt at an interest rate of about 4.5%, and the loan will be available for about 25 years. The rental annual increase, we are assuming it at 2%, and the expenses are also increasing at 2%. So basically it is cancelling each other out, right? So now how do we solve this model? So first, let's get into our model and first calculate the revenue. So the revenue, we will go to the assumption sheet. Now you want to link everything from the assumption sheet. So if you see, our rent is available on a per square feet level, which is 40 square feet, which is $40 per square feet, right? You want to put a dollar sign to that, multiply it with whatever space we have, right? Which is 2,95,566, right? So if I multiply that, then I tend to get, but I want to convert this into millions so that the numbers doesn't sound very high, right? So what we've done out here is we've just multiplied the total space that we have, and we've multiplied it with the rent per year. So now, as I was saying, the vacancy lost. So the vacancy lost is 10%, which means out of 11.82 million, about 10% will not be occupied. So that is what we need to calculate and keep it ready, right? So that is 1.18. That means the gross rent actually available is about 10.64, right? Now, so I'm going to do for the first year entirely, and then you could quickly do it for all the other years, because it's just dragging the formula to the right. Now again, all the expenses, what we're going to do is we're going to multiply. Now this is where the challenge will come, because all the details out here is given as per unit, right? So a easy way of doing this calculation is to find probably how many units are there, right? So you could see that 8 units are there, right? And that is not going to change. Multiplied with these expenses, there you go, right? And divided by 10⁶. 10⁶, because it is in millions, right? Now B8 is B16. We want to keep the assumptions changing. So I'm going to put a column $sign here, and then I'm going to put it down until insurance. So we will have to just check what is the insurance. Insurance is fine. And then property management fee is what we need to calculate manually. So we're going to multiply the 5% to $sign to gross income, right? So the gross rental income. So that's about 0.53. Interest we don't know as of yet because we have not created the debt schedule. So we're just going to keep it open at the moment. And we're going to just add up everything. Okay, so that's about 4.28 of total expenses, which will change later on once we also find interest, right? So now what you could do is you could populate these cells for other years as well quickly, so that we are able to move into the cash flow calculation, right? So now revenue changes, as we know, the only way revenue is going to increase is by the rental increase, which is given as 2%. So I do the 2%. Vacancy lost is obviously going to be same, so that doesn't change. The R&M, all the other expenses also are expected to increase by 2%. Right, so I'm just gonna put that here and drag it down. And the property management fee, of course, is the same because it is calculated basis the percentage. Now, since we are done with the second column, we can just quickly drag this across to 10 years. Right, there you go. So those are our values for the total expenses which are incurred. Now, what is net operating income? Is nothing but the gross income minus the total expenses. Drag it to the right. There you go. Right. So we will just quickly check whether our insurance calculation is correct or not. So it is 89587 because I have a feeling that probably this calculation is not showing up correctly. So anyways, we will just try it out once, which is 89,587 multiplied by 8 units divided by 10 raised to 6, right? So now the calculation is correct. Right, so there you go. So that's our net operating income, which we spoke about in the presentation. Now, so if you see out here, I'm just gonna quickly freeze the pane here so that we don't have to keep on looking up to find the the year in which we are referring to. So now let's come down and see that we are dealing with year 0 first, because that is where the acquisition is going to happen, right? So what we can do is, first of all, populate these values. So NOI at year 10 is how much? So we can just link it out here, 6.75. The exit cap rate assumption was given to us. So the exit cap rate which is given to us is about 5%. That means that is the intent. At that, at least we should be selling, right? Not necessarily we'll sell it at that rate. Now, so if the NOI at year 10 is going to be 6.75 and the exit cap rate is going to be 5%, then what will be the value at which we will sell? So it's a reverse calculation, because how do we usually find the cap rate? We find it by, so I'm just going to show you the formula quickly here. So if we divide the NOI divided by the market value, right? So this actually gives us the cap rate, right? So now if the cap rate is given and we know the NOI, so we can also find the market value. So we can take the market value to the right and we can divide the NOI by the cap rate, right? So that will give us the market value. So it's nothing but a reverse calculation, right? So that's about 134 million, right? So at acquisition, now that is where the calculation all will come up, at what rate we have acquired the property and at what rate we are intending to sell, right? Now, let's create the debt schedule. So how much debt are we taking? So it is the 65% of the property value. So what is the property purchase price? It is the space multiplied by $411 divided by 10 raised to 6, right? So that's about 121 million of debt is what we're taking, right? Now, just like how we usually make the debt schedule, so opening debt is the closing debt of last year, and EAI means equated annual installment. So we're going to use the PMT function. So the interest rate is given on the next page, which is 4.5, put a dollar sign. N per is the number of years of amortization that we're going to assume. The present value of the loan is given out here at 121, put a dollar sign. Future value of a loan is always 0 and type is 0. That means at the end of the year is when we're assuming that the payment's going to happen, right? Now interest is nothing but opening debt multiplied by the interest rate, which is about 4.5%, right? So that means if you find out the difference between the repayment, the EAI, which is 8.19, and if interest is 5.46 out of it, then the remaining is nothing but the principal repayment, right? So I don't have to possibly, hopefully, I don't have to tell you this because this is basic time value of money stuff, which you should be knowing. And if you don't know this, then you can also look at my other lectures in which we have spoken about this, right? So what is the closing debt? So the closing debt is nothing but the opening minus the repayment, right? Or plus the repayment, because it's a negative sign already, right? So there you go, that's the closing. And now nothing, we don't have to do much, we just drag that across to 10 years, right? Now the only thing that I'm going to assume in the last year is, just for the sake of the calculation, I'm going to assume that at year 10 we take up all the debt which is there, 92, and we pay it off. Okay, because since we're also going to get some proceeds by selling the property, so there's no point practically making the debt run for 25 years, right? So what we can do is we can take a negative value of the opening debt and put it in repayment, so that will make the debt 0, right? So now we can come to the cash flow calculations. So at year 0 is when we are purchasing the property. So this is the full purchase property, including our own contribution apart from the loan. So that is 29,000, whatever this 556 area is there, and multiplied by $411 divided by 10⁶ to convert into millions, right? I think we assumed something wrong here. Yes. In the closing debt, I think I by mistake did not multiply the 65%. So that's the reason why the debt is looking pretty high. Now it's fine, right? So that's the purchase price. And so I'm going to put that in negative, because cash flow calculations, we are talking about the total investment as being negative 121.474. The debt, since it's a cash inflow, it comes up as 78, right? Because debt you are taking, right? So somebody's giving you debt, so it is positive cash flow. That means, and also we'll link the NOI, which is going to be in this row, right? So that would give us the total cash flow, right? So we don't have to really worry about once we've done this. So 42.5157 automatically becomes my own contribution. So now you understand why we are doing this calculation this way, because we are really interested in the return that we make as an equity investor, not really at a project level, right? That means at a property level, right? So now we'll just drag this to your, so there you go, right? So that's your purchase price, that's your debt raised, this is your investment. Now we'll also link the interest that we are repaying in from this sheet out here, right? So that our cash flows are correctly calculated. And from the next section onwards, in the debt raised and repaid, we will also link the debt repayment which has happened, right? So there you go, that's the debt repayment. Now remember that at year 10 we would like to sell the property, right? So the same place where we put the purchase price, now we're going to put the selling price. So selling price we already know, because we have already calculated out here that at 81 million is where we want to really sell it off. Now this is just an assumption that we are selling at 81. It's not necessarily, the lower the cap rate, the higher value we will sell it off, right? But we can do that sensitivity by making the sensitivity analysis, right? So that's our basic cash flow calculation which is done out here. Just to make things simpler, we can reduce the decimal places so that it looks a little legible. Out right now it doesn't mostly look legible because there's so many numbers out here, right? So let's reduce the decimal places. Now it's looking much more easier to follow, right? And we can just bold this out and put a top row, top border out there, right? So that we know this is the total cash flow. Now, the most important calculation that we want to do is calculate the IRR, the internal rate of return. Select the cash flows, and of course it gives us negative 3% return, right? Now the reason why it is because we have assumed a very high exit cap rate of about 5%, right? If you change this to 2% and see what exactly happens, you will realize that the returns will increase, because it is logical, because you bought the property at about 121. Of course you're not going to sell it at 83. So my exit cap rate now I've assumed at 2%, right? Now, as a research analyst in real estate, you would probably be interested in trying to sensitize, or probably play with the assumptions. So you can take any kind of assumptions which you want to test it out. For example, we could also speak about let's say the rent assumption, because rent will make a lot of difference in terms of the return that we eventually make. So let's say we create some rental assumptions out here. So starting with, let's say, 40, right? And let's say we start from the lower side and then we increase it by $5 to create a range out here, right? So what would happen if the rents increase, right, to my IRR? Because eventually I'm just interested in IRR, right? Now I don't know whether you know how to create a data table which can also be made even with one axis. Okay, it is not necessary to have two axes all the time. So anyways, we will link the IRR calculation from the model out here, right? There you go. And then we will select this section. So out here is where my answer should come. Go to data, go to what if analysis, data table. Now this is where people tend to get confused, right? So now you need to understand that this is the column, right? So in column is where I have the rent assumptions, but my row is blank, so I'm going to select blank. But in my column I have my rental assumption, right? So there you go. Now this is nothing but IRR, right? So if somebody wants to interpret this is what I will interpret it as, that if your rentals are anything below 35, it would mean that you would probably not make good returns. I mean, you would probably make a loss, right? So the minimum to survive is $35 per year per square foot rent is what we need to charge. Okay. Otherwise, of course, it's not going to make sense. Anything above 40 is, the good place, because, if you go to 45, then you are able to make 21% IRR returns. Let's also see what will happen. So I'll just to make sure that this is understandable later on, you can make it as rent per square feet per year. Okay, so that you know what assumptions you're basically testing, right? And we can just rotate this up so that you know what exactly you're doing. Similarly, we can just copy this area and we can create more such sensitivities out here. So let's say now we want to test what will happen if probably the debt rates are changed. Okay, so let's say the debt funding, what happens to our IRR if we increase the debt funding? So we are starting at 65%, so maybe we start from 50%, okay, and we go all the way up to, so let's see till where we can go. 95% usually is not done, right? So we'll keep it at 90, and just for the sake, I mean, we can just ignore the value there, right? So let's delete this and now link the IRR. So I think the IRR is already linked. There you go. And now let's go to data, what if analysis, data table. So row input is going to be blank, but column input is going to have my debt LTV, right? So very marginal difference when we increase the debt. Okay, now why is that? Because and this is what you need to answer even in interviews, like why is the IRR not increasing as much as it should, even when we are going from 65% all the way to 90? That's because your rental increment is only 2%. If you were to change this to, let's say, 4%, right, and then look at the values, then you'll see that the IRR tends to increase a lot, because your interest rates are at 4.5% and your rental increment is at just 2%. That means it's not going to make a lot of sense to take debt itself, right? So if it's, let's say, 6% like India, right? So let's say this is 6%, the usual escalation rate in rent, then you will see that debt will make a lot of sense, right? But if your rental increment is not going to happen much, it's only going to be at 2%, then it's not going to work out too big, right? In fact, now if you see the rental increment that we've done out here, and then now you go and see the IRR, it has automatically increased, right? So that's basic realism. Of course, you can keep on playing with this for various other assumptions, but in a nutshell, at least to get into a job of real estate valuation, I think this much knowledge is more than enough at the moment. Please let us know what you think about this model. If you have any questions, please do put it in the comment box, and also check out our website on learning these skills for your future career. So I'll see you again.